Hello and welcome to my presentation on business finance, specifically short-term loans, asset finance and working capital solutions. Now I've set up the camera here, which I'm talking to now, but my slideshow I'm going to refer to down here. So I will be looking in this direction to make sure that I'm delivering the right message at the right time. Now this presentation will help you understand what types of finance you need to solve the challenges your business faces and how to make the most of the finance so that you can grow your wealth as quickly and effortlessly as possible. My business is called Capitalized Business Finance, and I provide both short term loans and working capital solutions. So, just about who we are lenders, we are not brokers. We make our own funding decisions and we fund our clients directly. So, the information here is from a lender's perspective, the what and how of business finance. Now, obviously, the information is very general in nature, and it really needs to be because each business has its own unique sets of needs and circumstances. So, the key is to understand how all of these work so that you can find the right solution for your business. Now, why are there multiple types of business finance? Well, the differences between the finance products allows financiers like us to fund clients of varying needs and abilities. And why do you need to know about the different types of finance? Well, nobody knows your business like you do, and nobody has to live with your decisions but you. So it pays to understand what you need and how you can solve your business funding needs yourself. Now, business finance is an unregulated industry, meaning that the rules and protections that we expect with consumer finance do not apply. It really is a buyer beware market. So, relying on slick marketing or sales techniques can lead to poor financial decisions. Also, think about marketing and broker commissions. Just like being able to pay for high Google rankings, some lenders throw a lot of money into paying for leads. Are these highly promoted finance facilities the best for your business? The key is to be sure of what you actually need. So let's start with why. Why are you in business? And this will probably apply to most people. Perhaps you love being part of a growing your community or helping people achieve their wants and needs through your products or service. Perhaps you have a better product or a better way to deliver your service and you want to be the best in your field. No doubt you've invested a lot of time, energy, emotions, and money into your skill or area of expertise. So it's only fair that you benefit the most from your hard work. Rather than working for someone else and giving away all of the profits, by running your own business, you gain maximum benefit from your hard work. Now, working in or managing your own business can be time consuming, but ultimately you decide how to spend your time. No more applying for leave, no more doctor's notes for sickness, no more feeling guilty about not being able to be there for your family when they need you. Also, when you manage your own business, you get to decide the direction your business takes, who you service, who you employ, how and where you expand and grow, and who you do joint ventures with. Now, it can sound daunting, but this is what it means to have the freedom to choose. And with higher incomes comes the ability to accelerate your wealth outside of your business. Now, I always like to look at a holistic picture, keeping in front of mind that your business is only a part of who you are. So let's talk about that now. Who are you? Who am I? Who are we? Let's look holistically. Now, your business is likely your main or one of your main income streams. Within family, there's everything we do and need to sustain happiness and health, including costs for our home, schooling, insurances, food, entertainment, etc. Basically, our living expenses. Now, I've used the term fun to encompass big ticket consumer items such as getaway holidays, personal discretionary spends on things like boats, jet skis, aspirational cars, concerts, fine dining, etc. These are the things in life that I would call smelling the roses. And investments. Now, investments are strictly true investments, things that put money into your pocket, not take money out of your pocket. So, your home is not an investment for you, it's an investment for your bank. Now, investments include share portfolios, commercial and residential property, allowing for some negative cash flows prior to realizing a gain, and anything else that someone pays you money to use or increases in value over time beyond the cost of holding the item. So for those people without investments, this is probably what their money flow looks like. Business income split between family and fun. What we'd probably like to do is divert some of that income to grow our investments, because eventually we won't want to keep on working in or on our business. We'd like to be able to live off our investments and enjoy life without financial stress. So, having said all of that, what are your goals now? Perhaps they could be to maximize your income in the shortest possible time so that you can fund your lifestyle and build your investments or nest egg for your future. How do you maximize your income in the shortest possible time? Well, one of the keys is to utilize the right types of finance that's designed specifically for your needs. Utilizing the wrong finance reduces your ability to maximize your wealth. Now, why does the type of finance matter? Well, all of us, individuals and businesses, have a borrowing capacity. It's a limit on how much funds you can access based on your existing net worth and your debt serviceability. Now, most people know what net worth is. It's basically the sum of your assets minus the outstanding debt on them. Your debt serviceability, however, is a calculation based on your total income and total expenditures that determines how much total debt you can afford to repay. So you could be asset rich, but still not have the debt serviceability to borrow a dollar. So why does the types of finance matter? Well, different forms of finance will affect your funding capacity differently. Just like oils ain't oils, and some of you might be old enough like me to remember the old Valvoline commercial, money isn't money. Now, I've used the word funding instead of borrowing here because not all forms of finance involve debt or borrowed money. We'll talk about that soon. So, what do I say? Money isn't money. The different types of finance are structured differently, meaning that some types of finance will affect your borrowing capacity while others won't. So, let's just recap. Your borrowing needs to service your wants and needs, and these include your house and home, your business assets, working capital in your business, your investments outside of your business, and luxury expenses. So now that we've seen to what and to where our money needs to flow, let's look at three common business finance options. The first one is secured business loans. Many people know about these. There's thousands of these on the market. These are generally secured against property, a fixed asset such as residential or commercial property. Alternatively, some lenders will be able to secure a loan against floating assets such as stock or inventory, or even your accounts receivables. However, a word of warning on loans secured against your invoices. Try to avoid these because there's a much better way to utilize your invoices for business finance purposes, and we'll speak about that soon. So, some features of business loans to note are that the borrowings are capped, and the cap is based on the portion of the value of the security and your debt serviceability. Okay, so there's a limit. Funds can be used for any business purpose, and if you're using equity as security for a loan, doing so reduces the equity available for more secured loans in the future, including for personal use. Now, a word of warning here using loans for some purposes. Beware of fixed repayment schedules and how they align with your cash flows. So if you receive income every 30 to 60 days, but your loan repayments are fortnightly, then fixed loan repayments can create a cash flow problem in your business. Now, in many industries, customer payment terms are end of month plus 30 or end of month plus 45 days, meaning that can be up to 75 days from issue of an invoice before payment is received. These are often more stable, larger, more profitable contracts, but they do come with extended payment terms. So if you take out a loan to cover you over the 75 days, then you need to account for loan repayments before you receive income. Now, I've seen many businesses fall prey to easy application and fast turnaround for business loans, only to find that the loans make their cash flow position even worse. I'll talk about a much better way to manage cash flows soon. Now, asset finance, unlike secured loans where your borrowings are capped by the value of the security, asset finance is generally secured against the equipment you're purchasing. So your debt serviceability will be the key to your borrowing power here. The debt serviceability will determine the value of equipment you can afford, keeping in mind that your income may increase by more than the cost to service the loan for the equipment, or it might not. It might be a critical part of equipment that doesn't really add too much to your bottom line, in which case your debt serviceability will reduce. As mentioned, doesn't impact your equity or security position. The equipment is the security for this finance. And depending on how it impacts your debt serviceability, it could impact your future borrowing capacity via a reduction in your debt serviceability. So your future borrowings here include borrowings for all items we discussed earlier. Now, some lenders will be able to separate business finance from personal and investment finance. However, all lenders will make a decision on how much they are willing to lend you against everything you are exposed to. Okay? And lastly, receivables finance. Now, these are generally secured against your business receivables invoices. Now, how does receivables finance work? Well, it's effectively a buy-sell agreement between you and the financier. The financier buys your receivables invoices off you. All right. So your receivables invoices are assets in your business, and by using this type of finance, you turn these assets into cash. Okay. It does not impact your debt serviceability. Now, there is a fee for the service, but if you utilize a flexible solution that doesn't lock you into a contract, you can manage your costs and hence debt serviceability to meet your borrowing needs. Okay. It does not impact your equity or security position. It's simply your receivables invoices that form security for this facility. And keeping in mind, again, what I mentioned about debt serviceability, it doesn't impact your borrowing capacity. So, receivables finance is not a loan. It's not a debt and does not impact your balance sheet. Okay? So, let's talk a little bit more about receivables finance. I'll start with the question. Who would like to make $1 million profit? Probably everyone, I'd say. But over 30 years, that doesn't sound so good. Over 5 years, not as bad, but not quite happy yet. What about over 2 years? I'm sure many of us would be happy to make it over 2 years. Some of us would be happy to make it over 6 months. Equally, who would like to make $5,000 profit? And again, time-based. The key here is that we all recognize that we do want to make a profit and a healthy profit, but the faster we make it, the better off we are. Okay? Making a profit is your goal, but making a profit as quickly as possible is the key to wealth creation. By making money quicker, we can divert some of it to our investments to help grow our nest egg over time. Okay, well, let's keep that in mind. So, how do we measure the time it takes your business to generate a profit? Okay, we're measuring time here. We measure the cash conversion cycle. Now, this is the key. This will tell you how hard your dollars are working for you. You want to maximize the return from every single dollar of working capital in your business. And this is the key on how to do it. So your cash conversion cycle can be calculated using this formula. It's the number of days it takes to turn over stock or deliver your service, plus the number of days you're waiting to get paid. You might give your customers 7 days credit, 2 weeks credit, 30 days, 45 days. That's how long you're waiting to get paid. Minus the number of days you need to pay suppliers. So once your suppliers have given you the supply, they might give you a week to pay it, or 2 weeks to pay it, or 30 days. Okay? So let's look at an example of how this formula works. Let's say it takes you 10 days to deliver your service to your customer. Once you've finished, you issue them an invoice and you allow them 30 days to make payment for that invoice. At the same time, suppliers to your business require you to pay for their supplies within 7 days of receiving their invoice. So in this example, your cash conversion cycle is 10 plus 30 minus 7, which is 33 days. Okay, what does it mean? It means that it takes your business 33 days to realize a profit from every dollar of working capital. Is that a problem? Well, a few questions. Are your customers and suppliers' bank accounts the best place for your money to be? You've paid your suppliers, you're waiting to get paid by your customers. Your money is sitting in their accounts, helping them run their business. Are you happy to be funding your customers and suppliers' businesses while you wait to be paid? Now, these may not impact your business. They could be philosophical. However, this one, are you waiting to be paid before being able to start your next project or job? If you answered yes to any of these, especially the last one, then you have a cash flow problem. So shorter cash conversion cycles mean that you can generate profits in shorter periods of time. Okay? So making profits quicker means that you can make more money on any given amount of time. You can increase your profits by making each dollar work harder for you. And what we are aiming to do is minimize the cash conversion cycle. And yes, it's possible to have a negative cash conversion cycle where you get paid by your customers before having to pay suppliers. So, what are the keys to reducing your cash conversion cycle? Well, just a reminder of the formula of the cash conversion cycle. The 3 keys are: number 1, reduce the number of days it takes to turn over stock or deliver your service. Now, this is not always easy or perhaps even achievable, but because it forms part of the equation, it's one of the keys to reducing it. Number 2, reduce the number of days it takes to be paid by your customer. Now, there are many options businesses can use to achieve this outcome, and we'll discuss some of them soon. Or number 3, increase the number of days before you pay your suppliers. Again, there's options there available to businesses to be able to achieve this outcome for themselves. So, before I go further, I want to ask you, how does a loan reduce your cash conversion cycle? To be able to do that, it needs to impact one of these 3 things. Does a loan reduce the number of days to deliver your service? Nope. Does a loan reduce the number of days waiting to get paid? Nope. Does a loan increase the number of days you need to pay your suppliers? No. So how does a loan reduce your cash conversion cycle? Well, it doesn't, right? Loans do nothing to reduce your cash conversion cycle. They do nothing to solve your cash flow problems. Loans only mask your cash flow problems until they surface again. So, what type of finance lets you manage your cash flows? Well, working capital finance does. It allows you to manage when customer payments come into your business and when supplier payments exit your business. By using either or both receivables or payables finance solutions, you can reduce your receivable days and increase your payables days without any impact on your customers or suppliers. You can minimize your cash conversion cycle without affecting your customers or suppliers. Now, some common names for receivables finance are debtor finance, cash flow finance, invoice finance, and factoring. And some common names for payable finance are supply chain finance and trade finance. There's many different lenders in the market with many different products, but not all finance is created equal. As I mentioned before, business finance is an unregulated industry. It really is a buyer beware market, especially in relation to slick marketing and sales techniques. Don't rely on advertised rates. Many lenders will hide fees and charges in their terms and conditions, which can greatly inflate the true cost of finance. So what are some of the variations between facilities? Well, some facilities have a minimum term. It could be 12 months, could be 24 months plus a notification period, in which time you are locked into the contract and cannot exit the contract unless you pay a hefty fee. Some facilities employ a cap where the financier will decide, yes, we're willing to help you with your cash flow needs, however, only to a maximum of $200,000 or $300,000 of advance funds. Now, that's fine initially as your business grows, but if your business grows beyond the point of that funding cap limit, well, then effectively that growth stalls until you find a new solution to your funding needs. And many facilities do have extra or hidden fees and charges, right, including things like application fees, legal fees. Some of these are one-off fees. Some of these are recurring fees every month, monthly account fees, minimum or floor fees. Watch out for these. These are fees that a financier will charge if your business does not generate the turnover it's expecting and the fees they expect to generate from your business activity. So if your business experiences a downturn for whatever reason and you're not generating those invoices, your financier will still charge you a certain amount based on what they're expecting to get out of your business. It's sort of like kicking you when you're down. Line fees, these are another interesting fee. It's like you're paying a fee to your financier for them to hold a certain amount of money in a separate account of theirs for you to use for your financing. So it's a fee for no service yet, and exit fees and others. So you can find these fees hidden in the terms and conditions of each financier's clauses. Look for them, or at least ask questions on what extra fees and charges are payable. So how do you determine what's the best finance solution for your business? Well, you need to start by understanding, what do you need? So these are the questions to be asking yourself. Do you need to finance all of your invoices? Do you need to bring all your customer payments forward or delay supply payments, or just some of those invoices? Okay, so you might only need 25% of your invoices financed. You might have one big client who has extended payment terms and it's causing you cash flow issues in your business. How many invoices do you really need to finance? Do you need to finance all the time or just every now and then based on what your business needs at the time? Do you like being locked into a term contract? Or would you be better off with a facility that allows your business to pivot based on changes in the market? Now, being able to pivot can be a game changer for your business. COVID was an example of how markets can change overnight, or a sudden opportunity for business growth can present itself at any time. So being able to pivot your business quickly means that you can take the upper hand over your competition. Having flexible finance allows you to pivot quickly and effectively. Now, do you need a facility that will grow with your business, or are you happy with a cap on the finances, as previously discussed? Now, do you want to have complete control over your financing needs and costs, or you're happy to be charged a fee for a service without knowing how much finance you'll actually get? Now, this may sound unreasonable, but there are some forms of cash flow finance where you pay a fee to the financier for them to simply decide whether to provide you finance or not. So once you've answered these questions for your business, you can then search for a facility that provides what you need. Now, make sure to read the contracts yourself. Don't rely on insurances from salespeople or brokers. Okay, so let's talk about my business, Capitalized Business Finance. Here are some of the features of working capital finance solutions from Capitalized Business Finance. So receivables finance. Some of our features are no locking contracts, no entry fee, no exit fee. There's no requirement to use the facility for a minimum of one term, one invoice, whatever you need. Okay, there's no hidden fees, as mentioned, no application fee, no line fee, no exit fees, no floor fees, nothing. There's only one fee, and it is only charged when an invoice is financed. Obviously, with locking contracts, you get to decide you, whenever you finance and how much you want to finance. Okay, and you can finance all or parts of an invoice, sort of like using an invoice as a drawdown facility based on business needs at the time. Our receivables finance features very similar. Again, no locking contracts. Finance as much or as little as you want. Okay, no hidden fees again. Everything is disclosed upfront, so everybody knows what the cost of a facility is as it's being used. With no locking contracts, again, finance only what you want and when you want it. We have flexible repayment options on an invoice by invoice basis. Now, one of the benefits of our supply chain finance solution is that it does provide an automatic cash flow solution for your suppliers. Your suppliers can elect to take payment for their invoices whenever their business needs it. And in doing so, it is a cash flow solution for them and it strengthens their business, thus strengthening your supply chain. And one unique feature of our facility is that there is an opportunity to earn a rebate on some of your supplier invoices and thus increase your margins. So that's just a little bit of a cherry on top. So if you want to find out more about the finance solutions provided by Capitalized Business Finance, please visit the website. There's plenty of resources on there as well. This is the front page of the website. On the top right hand side next to the Collect with Us, there's a resources button that you can click. It'll take you to this page. The first video is effectively talking about the cash conversion cycle and how to use it to grow your business without any borrowed funds. Directly under that, there's a scrolling table that you can see 3 videos there. There's many more videos you can scroll through talking about debtor finance, supply chain finance, how they work, what to look for, how to use them to maximize benefit to your business. So plenty of resource videos there, and directly beneath them, if you don't like videos, there's a few blogs there as well. So thank you very much for listening to this presentation. I hope it's been beneficial for you, even if to spark some questions that you've got. If you do have questions, visit my website. I've got some contact information there. Feel free to send me an email or call me. Happy to discuss anything that you don't quite get or got some questions on, or even if your business needs any forms of finance, happy to talk to you about it to make sure that you get what you need that best suits your business. So thank you and good night.